Good afternoon, everyone. Welcome to our webinar, the first webinar that we have for 2014 from the Office of Small Credit Union Initiatives. This afternoon, we're going to be talking about products and services for underserved members. My name is Catherine Baxter. I'm going to be your host for this afternoon, along with Vanessa Lowe. But before we begin our webinar, we'd like to go over a few administrative items. At any point in time, you may feel free to submit a question using the Ask a Question box that's on your console. It's on your left-hand side. In order for you to be able to download the presentation, you can use the green resource widget that's at the bottom of your screen, and that way you can have access to the PowerPoint presentations or print them out. After our webinar, we're going to send you a survey, so stay on the line because we'd like to get your comments. Always, we close caption our webinars within 3 weeks of the presentation. Today's webinar is going to be very interesting, and to get us started, I'm going to introduce our first speaker, who is Vanessa Lowe. Vanessa is an economic development specialist with the Office of Small Credit Union Initiatives, and Vanessa knows quite a bit about this particular topic. So I'm going to turn the console over to Vanessa right now. Vanessa, we're waiting to listen.
Thank you so much, Catherine, and welcome everyone. This is a very exciting webinar. We have been talking about the low-income designation for about a year and a half now, and we've had about, I think this will be our third webinar that's speaking to those credit unions that serve a large portion of low-income members. I want to say, though, that this is we're welcoming everyone on this call because in today's environment, all credit unions should really be very much aware of serving the underserved. And so on this call, what we'll be covering today are several things. First, I want you to get familiar with the main speakers who will be on the call. So we'll do some guest speaker introductions, and you'll see their faces in a moment. Then I'll give an overview of the 2014 Community Development Revolving Loan Fund Grants Program. It's been announced, and one of the initiatives that we're promoting is for CDFI certification, so it's related to what you'll hear from some of our speakers today. So we'll talk more about that when I get into the grants program. And then the main portion of the call will actually be 3 different case studies. We have presenters on the line today from 3 very different credit unions. One is Elliott Federal Credit Union in Jeannette, Pennsylvania. The next speaker would be from Marisol Federal Credit Union in Phoenix, Arizona. And the last is St. Louis Community Credit Union in St. Louis, Missouri. Now, we've selected these speakers because they're at various stages of developing products and services for their members. So when we start with Elliott, you'll hear about sort of a starting relationship in a partnership that credit union is developing and how that manager is working with his board. And then Marisol is a little further along the process, and you'll hear about an interesting product they have. And then the final speaker, I would say, of the speakers is the most advanced, and so he'll be talking a lot about his partnerships and other ways that his credit union has grown almost astronomically as a result of really reaching out to the underserved. So we will be talking for about an hour, and then the last half hour of the webinar is dedicated to questions and answers. So I want to encourage you to start asking questions whenever you need to. You'll notice that there is a QA button. It's in the bottom middle of your screen. It's red and it has QA on it. And when you click that, it toggles open the Ask a Question box. And so you type that right in, and we'll start collecting the questions. And we have our Catherine and Diane Rector who will be moderating the questions and then feeding them to the speakers when we get to that last half hour. The other thing I would ask you to do is to clarify who you're asking the question to. You can ask it to everybody, but during each speaker you might say, oh, I really want to hear from Robin about that. Okay, so just make that clear when you ask your question. Okay, so let's move on, and let's get some faces on the screen. Excuse me. Okay, so the voices on the webinar. So I'm going to start. My name is Vanessa Lowe, and as Catherine said, I'm an Economic Development Specialist with the Office of Small Credit Union Initiatives. I've been with NCUA for about 6 years now, and before that I was with the U.S. Treasury Community Development Financial Institutions Fund for about 7 years. I'll leave it there, and now I'll turn it over to James Benson.
Good afternoon, everybody. My name is James Benson. I'm the CEO of the Elliott Federal Credit Union. I've been with the credit union for 14 years, and I've been involved in credit unions for about 22 years. Thank you.
Buenos dias from lovely, sunny Phoenix, Arizona. I am Robin Romano. I'm the CEO of Metasol Federal Credit Union. I've been here 15 years. Prior to that, I worked for NCUA.
Good afternoon from the moderately cold St. Louis. My name is Paul Woodruff. I'm with St. Louis Community Credit Union. I've been in the credit union industry for about 6 or 7 years now, and with St. Louis Community Credit Union in particular for the last 4.5. Glad to be here today.
Wonderful. Thank you, speakers. So the next slide, we want to start getting to know who's on the webinar. So this is a question I think that we ask on all of the webinars. We want to get a sense of the diversity of the asset size of the credit unions who are participating today. You'll notice there's a series of options. This is a choose one option survey here. So is your credit union, in terms of total assets, less than $1 million, 1 million but less, greater than or equal to 1 million but less than 10 million, greater than or equal to 10 million but less than 50 million, etc. So click the button that corresponds to your asset size. We're going to give that some time for you all to respond to that. I'm going to keep pressing the refresh button here, and we're getting some responses. Okay. The predominant so far is greater than or equal to 10 million, but less than 50 million at 32%. And it dropped down a little bit. Okay, I'm going to push these results. Thank you for your responses. We have 2 more surveys, so prepare to interact with us. All right, so it looks like a small number of the less than 1 million credit unions. The predominance is the greater than 10 million but less than 50 million at 31%. And then we have some that are greater than 50 and less than 100 million, and we're happy to know that there are also some greater than 100 millions on the line. So thank you for that at 15%. Okay, so we've done the survey. Now let me get into the 2014 grants round. So every year, the Office of Small Credit Union Initiatives manages the Community Revolving Loan Fund Grants Program. This program allows low-income designated credit unions to apply for funds that will help support them in providing more or better services to their membership, predominantly to underserved members. The guidelines have already been posted. They went out on December 6, 2013. So if you have not found them or gotten that email or looked at them yet, I encourage you to do that. Go to the NCUA website, and under the OSCUI link, OSCUI, I'm forgetting how we spell our name, Office of Small Credit Union Initiatives, we have a page on the site, and there you'll see a grants button, and you'll get the details there. The application round is, you'll have a very short period. The interface, it's an online application, opens on February 3rd, and it closes on February 14th. So please make sure that you review the guidance, decide what you want to apply for, and be ready to apply within that very small period, okay? Right now, for this round, there will be a maximum amount that any credit union can apply for that is $16,500, and you can apply in the 3 different categories. All right, let's talk about the 3 different categories of assistance that you can apply for in the current grant round. The first is new products, and we've changed this around a little bit. In the past, you would apply for a new product, you'd do some research, you then ask us for an amount of money, and you'd have to provide a lot of backup documentation. we've actually tried to simplify the process and identified what we think are some of the most important products and services, products here to provide to your members, and we've done the research on what the average cost is, and so if you apply for this, you'll notice that we have identified the amount that you would get for it, okay? And so it's things like the first ATM, online banking. We really want to encourage the small credit unions and the low-income designated credit unions to be ready to respond to those members that really want to use more technology. And so basic things like an ATM, we encourage you to make sure that you have that, and we want to support you in getting that. You'll also notice that we're promoting electronic or digital signatures, remote deposit capture, electronic bill pay, prepaid and debit cards, and your first website if you haven't done that. So that's the first category, is new products. The second category of assistance is student internships. We know that it's a great time to really encourage young people to get into the credit union movement, and we want you to do that. There's a $4,000 maximum for this particular category. Now, this time it has to be a high school or college student. In the past, we've said an underemployed person or an unemployed person. We've moved away from that, so it has to be a student. And the window is you need to hire by July 15th and end the engagement by August 31st. Now, here's the thing. If you receive funds for this category in 2013, we won't be funding you for that again this year. So just be aware of that and don't waste that category in your application, okay? We really want to get some new applicants here. Now, the third category is what most relates to the speakers who will be talking today. Of the three speakers, two of them are CDFI certified. CDFI stands for Community Development Financial Institutions Fund. I mention that briefly because I worked there in my last employment. And this institution, it's a division within the U.S. Treasury Department that supports financial institutions that have demonstrated a commitment to serving underserved populations, low-income communities, et cetera. The predominance of the institutions that are certified by this agency are what are called non-regulated loan funds. But the second largest category is credit unions, and we at OSCU, we really want to support more credit unions to pursue CDFI certification. So the third component of our grant round is a challenge to try to get 40 more credit unions certified. We will be offering $2,500 maximum for a credit union to find a consultant or get some support to submit that application. The word on the street is that it does involve a little bit of work, often some technology and some analysis, and so it's not unusual to need an outside consultant to help with that application. So we've got $100,000 and, again, hope to provide 40 grants to support more credit unions being CDFI certified. Now, one component is you're going to need to pass a capacity index, and one of the things we want to do is just make sure you're not sort of wasting your time by getting those funds. So at the base level, credit unions are expected to have a demonstrated commitment to serving the underserved, and so we'll ask some questions around that and also, some basic financial capacity questions. All right, so again, that's a challenge, and we encourage you to consider applying for that CDFI Certification Assistance Funds. Okay, let's move now into the next question, the next survey. What we want to understand is, of the groups that are on the webinar, how many of you have experience with the CDFI Fund? This survey, you can press as many buttons as you need to. So the questions are, have you heard of the U.S. Treasury CDFI Fund before this webinar? Click that if so. Have you applied for CDFI certification at any time in the past, whether you were approved for it or not? Have you achieved CDFI certification? Have you applied for CDFI program funding? That's the thing that two of our credit unions on the line have received funding, so you'll hear more about that when they speak. Have you received a CDFI program award of any kind? And so the CDFI program is a specific program, but they also have different programs like New Market Tax Credit and BEA. So think of that as the larger, have you ever gotten anything from the CDFI Fund? And the last question is, have you partnered with a bank enterprise awardee? One of the programs of the CDFI Fund is it provides incentives to FDIC-insured banks to make investments in community development financial institutions and other community economic development programs. And one of the main ways that they do that is they might invest money in a credit union, say a CD or something like that. So very often there are credit unions who have received essentially partnership funds from bank enterprise awardees. So I hope you're pressing the buttons. Let me go to the poll results and see how we're looking here. All right. We've got a couple of folks. It looks like 8% of the participants have achieved CDFI certification. Okay. All right, I'm going to push the results out. As soon as there we go, push these results. Okay. So this is good. I like that most of the credit unions on the line or the participants on the line have heard of the CDFI Fund, so that's great, 84.5%. 2.5% have applied for certification, 9% have achieved certification, 1.9% have applied for any kind of CDFI program funding, 1.9% have received a CDFI program award, and 0% have partnered with a bank enterprise awardee. So that might be a topic that we'll cover in more detail in a future webinar. Okay, right now I'm going to turn it over to James Benson. James, go ahead.
Okay, thank you very much, Vanessa. Good afternoon, everybody. My name is James Benson. I'm the CEO of the Elliott Federal Credit Union. We were chartered in 1935 for the Elliott Company employees as a single common bond at that time. We're located in Jeannette, PA, Pennsylvania, and at one time we had the Glass City title because at one time we were the largest producer of glass in America, so that's why we got the title. We are a multiple common bond field of membership now. It changed in 1984. When I came on board at the Elliott Credit Union, we had about 12 million in assets and about 13 SEG groups, and as of the end of 2013, we had over 30 million in assets and about 150 SEG groups. As you know, what's going on in America, plants are shutting down, and so that's the problem. What's happened in Jeannette is fallen on hard times. The next slide is how to build a partnership, and we're new at this, so a lot of this is new for me, but we formed a partnership with a local organization called Jeannette Circles, and if I can just stop, I want to explain two things. Jeannette Circles was founded in 2008 by the Westmoreland Community Action. Now, Westmoreland Community Action is a private nonprofit human services organization and helps low-income, struggling families to improve their standard of living. A good partnership, I felt, and they asked me to get involved and provide this financial literacy course. And so I agreed. In fact, tonight will be the first course, so I thought that was pretty good. If we can go on to the next slide. Yes. And what you have here is the actual meeting between Westmoreland Community Action and the Jeannette Circles. It was well attended, and I think what that does is gets the community involved, and that's actually how I got involved. It was actually by chance for a Jeannette Business Association. I think anybody can do that. Any other credit union can do that. It really wasn't that hard. You just have to know where to go. And now that I know this, I look at that and say, well, you know what? There's always a Salvation Army. There's a church. We need to reach out to these places and help the underserved. The people, they're paying too much, and that's kind of where we're coming from. I've got the board of directors on board. I've got all the employees, and so we're just moving forward with this. And I think it's a very good partnership with the Jeannette Circles Initiative and the Westmoreland Community Action. I'll go on to the next slide. And part of it is this is just the beginning, so this will probably change. And what we've come up with was a second chance checking. we'll open the account. Maybe we won't give them the checks, but they'll go through their checking or share draft account. We do want them to attend a 2-hour financial education class. We try to get them to get direct deposit because they have to have an income source to have a checking account. We'll give them free checks and down the road or right then, depending on what happens, we may give them a Visa debit card. And we'll waive certain fees. With the second chance loan, it's pretty much the same thing. We want them to go through this financial education class, which is what I'm putting on tonight. Try to get some direct deposits. We'll assist them with a loan application. Start them out with a small loan to help them rebuild themselves, up their credit and everything. We'll also offer our Visa at 9.9%, after about 6 months of the direct deposit. Really what we want to do is try to pull them away from the payday lenders. As you know, and everybody knows that, I'm hearing it all the time. These people will never get out of that vicious cycle, and we're trying to pull them out of that. And so this whole program that we have, as you'll see with the other two speakers, is just the beginning. But I think that this is where we all need to be, and we're on board. And I think with more help, I think we can help more people. So I think that's it.
Okay.
Thank you.
Thank you, Jim. That's helpful. I just wanted to ask one question. Can you just give us a few words on the structure of the financial education partnership? So how many classes, how does it fit in with what they're already doing?
Yes. The classes are basically 3 classes, and it's broken down into anything from, the scams, frauds that are out there, how to budget, how to work your checking, the difference between banks, credit unions, what we can do. Now, also through these meetings that we have, we'll try to, get the word out there about the credit union. A lot of people don't know, and this is a way to say, look, we may have a member that works for a store down the road, and maybe we can say to them, we'll go talk to your boss, and we'll talk to them about maybe bringing in that business. So in essence, it's really helping them out, but also maybe possibly bringing in a business here, a business there. And I think that's how it goes.
Thank you. Thank you. All right, let's move on now. So that was our first speaker. Now we'll go on to Robin Romano. All yours, Robin.
Thank you. Greetings, everybody. I hope everyone's having a wonderful day. Metersol Federal Credit Union was founded as Maricopa County Employees Federal Credit Union, so we were a county employees credit union. In 2001, when NCUA pushed and allowed people to go out and serve unbanked and underserved areas, we took advantage of that because we realized that we had already been serving these areas. Our credit union is kind of in the middle of an underserved, underbanked area. And probably for those of you out there who serve county employees, you know that they're probably not at the top of the pay field. So we already had quite a bit of experience in that, so we started to expand into several areas and added about 20 zip codes in 2001. In 2009, we were merged with another credit union called Chicanos por la Casa, and that helped kind of tip us over the scales of serving greater than 60% of our field of membership to underserved areas. At that time, we discovered the Federation of Community Development Credit Unions, and we decided that it would probably be a good time to become CDFI certified. I know that Paul is going to talk a little bit more about the Federation, but all I can say is that it's a wonderful organization, and I could not have gotten my CDFI certification without them. And I say that, and I should note that I am a board member of the Federation of Community Development Credit Unions. So in 2010, we became CDFI certified, and the following year we applied for a grant from the CDFI Fund to better serve our markets. And that it was a $750,000 grant, a capital grant, which came at a really wonderful time for this credit union. And we've used that to expand. Over the last several years, we've grown about $4.5 million, and a lot of that has been due to having that capital grant. So we've been involved in serving the underserved for a while, and these are some of the products that we offer. Some of these products may help you in serving out. We do allow accounts to be open with only an ITIN. And an ITIN is a number that the Social Security assigns to someone who may not be, is not able to get a Social Security number. It's a legitimate number. It's a number that they use in order to pay taxes, and it's also a number that they can give to an employer. And we do offer accounts that you can open with an ITIN, as well as alternative IDs of a matricula, which is a special ID that is offered in Mexico, as well as international driver's licenses. We also, and probably many of you out there, have accounts that are only offered to a savings account at a $25 minimum balance. But we also include an ATM. I stuck that in there for an ATM card because so often the access is needed in order to get to their money, and having an ATM card is especially important. It's not a debit card, it's a true ATM card, and I realize industry is trying to get rid of ATM cards, but in serving underserved areas, this may be a very important tool for you. As well as having CDs starting as low as $500. This has been an extremely useful tool for us as well. And it's easy for somebody to accumulate the $500 and be able to put into an account that earns a higher rate of interest. We also offer IRA accounts for starting at $5. Yes, I said that, $5 measly dollars, a cup of coffee over at Starbucks. You can open an IRA account at Marisol Federal Credit Union. It helps people who may not be thinking about their future or don't think they have enough money to think about retirement. You can open an account for $5 to give yourself an edge. In addition, we also have a checking account program called Start Again Checking. This is for people who may have had a few dings on check systems. We do offer that at a fee a month, and it is a great way to be able to get people into a checking account product. We do offer that if you have had no NSFs over the last 12 months, that we will automatically upgrade you into a free checking account. And those are some of the savings products. We have found when dealing with serving underserved, unbanked, or just into CDFI areas, that you want to make sure you have both savings products as well as lending products. A couple of lending products that we have found that have worked extremely well for us are shared secured loans. Shared secured loans is a concept that's not commonly understood by these markets, and once they do, it's a great way to introduce them into the lending community in a safe way. We probably book about 75 shared secured, savings secured MasterCards a month, and normally for a $500 limit, although you can always do more. And it's been a very successful product, and most of the people that get these products graduate to unsecured lending over time. But one of our most successful products has been a payday alternative loan. We've been doing them since 2007. It's a $500, so small balance loan, 4-month repayment, 18% rate. We do charge an application fee that has to be applied to everyone, no exceptions, of $50. We report these to the credit bureau. It's a wonderful way for people to either establish, but a lot of times reestablish credit. And I'm sure everybody has fields of membership that need to reestablish credit. We've done over $6,800 loans. In the month of December, we did 110 of them. We also have a forced savings component on that. The member must save, as a part of their payment, $20 a month. So at the end of the 4 months, they will have $80 in savings. Yes, some of them do use the money to get another quick loan, but we have quite a few of them that use this as a component to start savings. Since 2007, and this really is a true figure, we have charged off less than $26,000 in these accounts. They've been a very successful product. They do require a lot of monitoring and they do require a lot of work, I won't lie to you, but it is a very good product to offer. We also offer a citizenship loan. We do have a large component of our field of membership that is of the Latino community. This citizenship loan can be used for Dreamers as well for deferred status. We offer a maximum of $1,000. It's a 12-month payback, and we offer 6% no matter the credit score. We do risk-based pricing, but on this particular product, we offer the same rate because we view this as a product to help the community. We do make checks payable to Homeland Security, and it's also been a successful. I've not yet had one of these loans go bad over time. I will say that in developing this product or this other product that self-help has is that you do need to develop community partners. Our first speaker, James, talked about community partners. It's very important when dealing in these areas that you have someone who will go out and say, I can point you in a right direction. I can put you together with a financial institution that can help meet your needs. Self-help also does a Dreamer loan. Their amount is lower. That's the actual dollar amount that's needed to send to Homeland Security to get deferred status. Deferred status is the legal status given to those young adults, and forgive me, but I don't remember what the age range is, so that they can eventually get to citizenship. The last product I'd like to talk about that we do is, again, working with a partner, a fellow CDFI in the Phoenix area, Neighborhood Housing Services. They had not gotten money for funding to do real estate loans, so we partnered together, and we came up with a product that met kind of the needs of our community. The Phoenix area got hit hard during the Great Recession. We had real estate prices that dived up to 60% in some areas, and that was bad for a lot of people, but it was good for people of modest means. It meant that they could afford a home more easily. Unfortunately, financing also dried up at the same time, and in our market, the ability to get private mortgage insurance became more difficult, and even FHA financing became more difficult. So we created a product where instead of having PMI, the borrower is self-funding with a monthly premium that they pay into a savings account. Our premium on that on a $100,000 loan would be 75 basis points or $750 a year or $62.50 a month. That $62.50 gets put into an escrow account along with their taxes and insurance, so they pay it as a part of their monthly payment. That money gets deposited into a savings account set up specifically for these loans for the member, and they can't have access to it for 5 years. On the 6th year, they can use 50% of the funds for home improvement, and after 10 years, they have access to all of it. If at any time during these 10 years that they default, the money that is in the savings account will be applied to their principal balance, thus acting as self-funding insurance. But it was also intended as a great way to help people of modest means develop savings, because we all know our houses don't stay in perfect condition. We have to fix a roof. We have to replace that darn washer or dryer, or the refrigerator goes out at the worst possible time, or flooring needs to be replaced. And our experience is that ways that you can help people of modest means save money is a good thing. This product is not intended for everybody. It is only intended for borrowers at 150% of the HUD AMI, which is average median income. You can look up your HUD AMI for your community. You can type it in and look at the HUD site for that. We're actually booking another loan this month. We have $1.2 million on the books on this, and this has also been a successful product. I'll knock on wood, we haven't had a foreclosure on this product since. Overall, I can say that it has been a wonderful experience, really moving to become a CDFI, and it's very humbling and rewarding to do so.
Robin, thank you. I want to drill in a little bit more into this product because I find it very interesting. Can you talk about the agreement that you have with Neighborhood Housing Services, and after the loan is closed, what's the relationship that they have with the borrower? What's the relationship that they have with you? Talk about that partnership a little bit more.
Certainly. The borrowers actually usually go to Neighborhood Housing Services first. They're their clients. We happen to be able to serve the same grouping of people. We are neighbors, very close by. Neighborhood Housing Services is a full lending unit, so they actually do the processing of the loan. They send it to Marisol for underwriting. We underwrite it, give the conditions of what we want. Neighborhood Housing Services actually closes the loan. We do have a written agreement, a formal legal written agreement for the self-funding PMI. That's a part of the documents. The loan is funded in the Marisol name. And then our particular agreement is that we allow Neighborhood Housing Services to take the origination fee, and then they also service the loan. We pay them a small fee to service the loan. So it helps them, but the loans are ours. So we do, while we don't book them on our books, they are booked as a other loan type. So Neighborhood Housing Services still has a relationship with these borrowers, but in order to have this loan, they have to open an account at Marisol so that we can open the savings account to put the self-funding. And I have to say that almost everybody who's opened an account has also opened a checking account. It's been a very win-win situation for us.
Great. Thank you so much.
You're welcome.
All right. I want to remind everybody that you can submit your questions. Remember, it's the red button at the bottom of your screen, that middle link, and it toggles to open up the Ask a Question bar. So please send your questions and let us know who you're asking. We have another survey. One moment. All right. We're having a little technical difficulty here, so I'm going to ask for some assistance, and then we'll get to our next survey. I'm pushing next. Give us one moment while we deal with this. All right, there's our poll question. We're pushing it out. Okay. Now, this question goes back to that conversation about low-income designation, okay? So we want to find out, and again, this is a multi-selection survey, so press any button that applies to you. Has your credit union been approved for low-income designation, whether you've accepted it or not? Has your credit union accepted the low-income designation? Has your credit union offered a second chance account or loan? Now we're trying to find out of the products we've talked about so far, what kind of things are you all doing with that? Has your credit union offered a payday alternative loan? And has your credit union offered classroom-based financial education? We know most of you are certainly sitting down with your borrowers and going over credit reports, but are you doing classroom-based financial education? And last is, do you accept the ITIN, and actually let's do both the ITIN and the Matricula Consular, or any alternative identification tools like that to open an account? So again, check all the buttons that apply to you, and we'll check on the results. All right, we've got quite a few responses so far. Keep pressing your buttons. This is interesting. Okay, let me refresh. All right, I'm going to push the results over. Okay, so it looks like 15% have been approved for the low-income designation. 26% have accepted it. That's interesting. And again, actually, it looks like 28% have accepted the low-income designation. Looks like 18% of you are offering some sort of second chance account or loan. I know those are becoming more popular, so that's great. And 22% have offered a payday loan alternative. That's interesting. 9% offering, 9.7% offering classroom-based financial education, and 5.5% accepting essentially alternative identification. Thank you for your responses. Okay, our last speaker is Paul Woodruff. Paul, I'm turning it over to you.
All right. Afternoon, everybody. I'm glad to be on this call and to share some information about what we've been doing out here in St. Louis for the last couple of years. And I think one of the important things just to remember is the context of the conversation. Each of the speakers that you've heard from have been talking about the steps that they're taking to build the capacity of their institution to better serve low-income populations. We certainly have had to adhere to those same steps, building our capacity, learning best practices, making some mistakes, and learning from those, and then moving along. And so our journey has been really interesting, and so we'll talk about that now. I think to set the context for what St. Louis community has done, you have to think back to the year 2007. We had a really pivotal decision to make, and it came down to a choice of where we were going to start to expand. Did we want to go out into the county outside of St. Louis City to serve a little bit more affluent population, or did we want to dig our heels in deep in the city in a more urban setting where there were less options for folks, where unemployment was higher, where incomes were much lower? And we took the latter of those two choices, and since then have experienced phenomenal growth, mostly because there's so many institutions that overlook the underserved populations, don't see them as an opportunity to really do a lot of good in the community. So moving into this, just to give you a little bit of better context about who we are. We are a certified community development financial institution. We have been since 2009. We're also a low-income designated credit union since 2009 as well. And as Robin had alluded to, we are members of the National Federation of Community Development Credit Unions. I can't sing enough praises for the Federation, and I have to say that many of the opportunities, or a great number in the last year or two that have come to us, have been generated through the Federation. These folks come from a variety of backgrounds, including the CDFI Fund and a variety of other community development settings, and have a wide range of expertise. So if you are considering looking into CDFI certification, I would certainly reach out to the Federation just to get some insight from them, because they're definitely willing to help. The last thing that I didn't mention on there is that in 2010, the credit union formed its own 501c3 nonprofit known as the St. Louis Community CU Foundation. And we've been able to leverage our foundation to be able to expand the financial education resources in the community that I'm going to talk about in just a second. So more specifically about who we are. We were founded in 1942 as the St. Louis Teachers Credit Union. We were seg-based. In the mid-90s, we converted over to a community charter so that we could better serve the wider population in St. Louis City and County. And just an interesting note, so I had mentioned in 2007, we decided to kind of change pace. In that year, we started to offer second chance checking accounts, credit building loans, payday loan alternatives, title loan alternatives, many of the things that both of the previous speakers had talked about. And we went from having roughly 26,000 members in 2007 to today having 52,000 members. It's thrilling in one sense, but in the other sense, it can be daunting, just considering the volume of transactions, the amount of traffic that's going through our lobbies, and all of the sorts. So we've been excited about that, but it's also made us really kind of reconsider how do we want to best serve the community. So I've drilled down some more specific information on there, and so we received our low-income designation in 2009, and as a part of that, just a couple of years ago, we reached out to NCUA to see what the percentage was of our members that met the low income criteria, and they came back to us with a staggering number. It turns out that almost 85% of our members live at 80% or less of the area median income. So you just take a consideration and think about that. So out of our 52,000 members, 80% plus are considered low income. That from an underwriting standpoint, that from qualifying members for accounts who may have past credit issues or check systems issues is daunting again. But that's why we utilize a risk-adjusted pricing model so that we can serve the market. We've adjusted our appetite to take on more risk. And in some recent reports that I've seen, it's 50%, closer to 60% of the loans that we have on our books. That's car loans, that's personal loans, you name it, are considered subprime. And so that has its challenges, but it's also very rewarding because we can see the fruits of our labor continually every day in and out. So the way that we define financial capability, and we talk about this quite a bit, is there's a couple of lenses. The three areas that I wanted to talk to you all today about is, number one, our involvement with the CDFI Fund. The second are the payday loan alternatives that we offer. And then the third is somewhat of a unique approach that we have to better serving low-income communities, and that's through our micro-branch initiative, which I'll talk about in just a second. So first, let's dive into the CDFI Fund. So we were certified in 2009, and we were very lucky, received a $750,000 grant on our first go-around. And those funds were set to cover loan loss reserves for a payday consolidation loan, otherwise known as the Payday Saver Loan. With this loan, just some specifics, there's no credit check. Rather, a member has to have an account with us for 6 months or longer. Some of the other features with that is that what we're trying to do is to combat the payday lenders in Missouri. The average payday interest loan rate is 444% in our state. So, and we know that many of our members have multiple loans. So we've been able to use this to be able to consolidate over 700 loans now, and be able to get people off of the treadmill of payday lending and get them into a healthier lending cycle. We do report payments from this loan to the credit bureau, so it also helps our members to be able to build credit so that they can get into some mainstream products. And along with that, just to make sure that we can reinforce some of the needs that are in the community. Our target market in St. Louis is African American. We're about 80% plus African American in terms of that, and St. Louis has a very unsavory distinction of being one of the largest unbanked cities in the country. I think we're number 3 now. So this is a real need that's out there, and we've been able to fill that with that grant. Just very briefly, in 2013, we were lucky again to receive an $847,000 grant, again from the CDFI Fund, to cover loan loss reserves for automobile loans targeted towards low-income populations that are having trouble getting a car so that they can get to work more easily. So we're really excited about the progress as that moves forward. We've been establishing relationships with local workforce development agencies through the city, through nonprofits and other outlets, so that we can make sure that we can deploy those funds in the most effective way possible and have the greatest impact. So next, we're gonna shift gears a little bit and talk more about the payday loan alternative that we have. Our program differs a little bit from Robin's program in that the way that we've set this up is that it's a $500 revolving line of credit. So it's available to our members as long as they have a balance available to them as they make payments. Again, there's no credit check with this. We use the relationship that we have with our members to qualify them. And along with that, we give our members some choice. So they can choose to have their repayment period for that $500 line be anywhere from as little as 90 days to 180 days. We found that giving flexibility to our members helps to decrease risk, but it also gives those members a little bit more ownership in that process. Many of these people have never had a mainstream loan before. And so with that, we want to make sure that we can give them the best possible chance for success. We do a forced savings component. So every time a member takes an advance from their line of credit, 10% of that amount goes into a secured savings account. So if a member were to come in and do a $500 advance, they would walk away with $450, and they would have $50 set aside in their savings account. The only way that they access that is when they've paid off the loan, and since we know that payday loans are cyclical, people use them time and time again, there's a propensity for our members to really build up a significant amount of savings. And so if you look at it by the numbers, currently on our books, existing Freedom loans or Freedom line of credits, we have just over 5,200. And what's interesting about that is that we ran a report recently, and it showed that we've got more than $5 million in that secured savings account. So $5 million spread out over those 5,200 loans. That's significant. A lot of people discount low-income populations and think that it's just impossible for this population to be able to save. But I think that this product has really turned that on its head, and we've been giving people the opportunity to get out of those abusive, predatory relationships. Now, I did talk about risk-adjusted pricing. The delinquency for this product is a little bit higher. It's approximately 10% now, and our charge-offs annually are about 10 to 12%. The program is self-sustaining, though. We do make some money off of this, and then those proceeds are pumped back into similar programs so that we can have long-term sustainability. Our members have found huge value in this. And that's why we want to continue doing that. I'd mentioned the Payday Saver loan, which we were able to start with that CDFI grant. What we're looking to do as a next step forward is to be able to increase the amount that we can consolidate from $1,000 to up to $2,000. We have a small pilot program that we're going to be running through one of our micro branches that we'll talk about in a second. But really, I mean, we've been able to take a lot of the lessons that we've learned over the last couple of years and modify this program so that it best fits the members' needs and that it best fits our needs as an institution to survive. So the third prong of that development plan or of the financial capability plan that I was talking about is our micro branches. In 2011, we started an effort to be able to better reach our membership in places where very low-income populations are frequenting. So we look at social service agencies, workforce development agencies, low-cost, no-cost healthcare facilities. And from that strategy, we have deployed 3 micro branches now. Now, when I say micro, I just mean in terms of the footprint of the actual branch. Inside of these branches, we do every single thing that a big brick-and-mortar branch would do. Open accounts, close on loans, help members with issues. So the first branch we opened up in 2011 was in a workforce development agency known as the Met Center. It's been extremely powerful for us to be there because there are 5-6 week classes that cycle through, so you have the same people there for 5 or 6 weeks, and as they receive job training, the branch manager that we have located there will assist in doing financial education training and then follow up with opening up accounts for people, many of whom are unbanked. And, as everybody on this line has probably realized over the last couple of years, if you don't have direct deposit capability, you either can't get a job or you get forced into an expensive pay card option. So we've been able to provide those opportunities to really build capacity for people, get them into an account, and teach them how to responsibly use that. Second branch, micro branch, is about 300 square feet, incredibly small, and we opened that up in a low-cost, no-cost healthcare facility. It's gone gangbusters. We do about 30,000 transactions a year through that facility. That's a huge volume for such a tiny facility that doesn't have an ATM and doesn't have a drive-through. So think about all the foot traffic that goes through there, but also the goodwill that we can then leverage through the partner that we work with. We're embedded inside of this healthcare facility. So we are able to establish a lot of trust with the community and to be able to work in a better capacity with them. Now, the third branch, and I'll get off of this micro branch initiative in just a second, is in a facility called the Kingdom House. Kingdom House does wraparound services, so you think about energy assistance, development classes, Head Start program for children, all of those things. The missing component was financial education, or was financial services. And what we actually did to get this branch opened, and again, this is about a 350 square foot branch, is that we found a bank partner, a community bank in the St. Louis region who didn't have the capacity to serve low-income populations but really wanted to do something big. They knew that we had an expertise with this, and so we were able to strike up a relationship with Carrollton Bank. They're about $1 billion in assets, and came to an agreement where over the next 4 years, they're providing operational dollars to the tune of about $50,000 a year for us to be able to actually operate the Kingdom House branch. So that's opened up the door wide open to a population that had no access to financial services, to be able to have a comfortable place to establish trust and to be able to use checking, savings account services, credit building loans inside of a facility that they're very comfortable with. And the relationship with the bank that we have could not be better. In fact, the community development officer that I work quite a bit with serves on the foundation board. I'm the director there, and so I have a unique relationship with this bank as well as some others who really would like to do something in a meaningful way that does not compete with us but allows us to do more. So over all of this, I would say that probably financial education is one of the biggest pieces, biggest and most crucial pieces. In 2008, we really decided to invest heavily in this area. As I mentioned, we subsequently formed the foundation as another outlet to be able to support our efforts. But we do financial education inside of our branch offices, inside of social service agencies. We do classes in the community just at large. We have online. We have over-the-phone services. You name it, we do it. And one of the unique features, if you look down at the middle of the screen, is the CU Excel Center. This is an initiative that was initiated not only by St. Louis Community Credit Union, but our foundation, as well as our bank partner, Carrollton Bank, to be able to launch this. It's a standalone 2,500 square foot facility in an underserved area. We opened up in 2012, and the purpose of the facility is to be able to provide a destination point for financial education. So think credit building classes, budgeting classes, home buying classes, small business classes. But in addition to that, we've got partners from Enterprise Car Sales that come out and talk about the car buying process. People from the YWCA who come and talk about the issues that are faced by underserved women, local health care facilities that come out. So really it's filling multiple needs that are beyond just financial education. And so through the process of delivering these services through the center, we've served about 3,000 people since 2012 just at the CU Excel Center. But if you look at everything that we do in social service agencies and other affiliates throughout the community, since 2008, we've reached just over 22,000 people. These are people who really do appreciate the services we have, that have opened up account services with the credit union, that have opened up loans with us. So really community development, it serves multiple aims. It helps the community, but then it also can help to be a business development agent for you. I've got some pictures of some of the classes that we've done at the CU Excel Center. In that center picture, that was our ribbon cutting. You'll notice that we've got a lot of people there, but we have our local congressmen, local state representatives, the city mayor from the little municipality that we're based out of. And then you'll see that we've got a number of people who are teaching classes in the other subsequent pictures. This really is a group effort, a community effort. We couldn't do these types of things if we didn't have strong partnerships with social service agencies, with local governments, and now with local banks who support what we do. So some of the key lessons that we've learned is that partnerships are an absolute must. That's how we've been able to better understand the ways in which we can serve the market in meaningful ways. That's how we've opened the doors to be able to insert branches inside of social service agencies to better reach the market where it is. The second point is that you have to leverage the demand for mainstream services in financially underserved areas. I got to be honest, there's no competition in St. Louis and our urban core. It's pretty much us. I'll give this anecdote. A number of banks have participated in the Bank On movement in St. Louis. Last year, they launched a 2-year initiative where they wanted to open up 20,000 accounts for unbanked populations. They've opened up roughly 1,000 in 1 year's time. So they've got a lot of work ahead of them. If you want to compare that with what we do on a monthly basis, we open up roughly 800 to 1,000 accounts. 800 to 1,000 accounts a month, and most of those accounts are coming from underbanked and unbanked populations. So it gives you a clue as to where our branches are and to the types of products that we offer. And that goes to the point I mentioned earlier, utilizing a risk-adjusted pricing model. You know, listen, we are very careful about how we deploy loan products, but we're also cognizant of the fact that if we don't adjust to the needs of the market, we aren't going to be able to underwrite loans in underserved areas. So that's been a huge part of us opening up to do second chance checking accounts, payday loan alternatives, title loan alternatives, those things. And through it all, through these basic principles, we've realized that St. Louis Community Credit Union is absolutely more than just a financial institution. We provide mainstream financial services. We work cooperatively with our 501c3 foundation to provide intensive financial education, and we are a destination point for consumer and financial and life skills education in the community. So any questions anybody might have, I'd be happy to answer, but I appreciate your time and attention.
Paul, thank you so very much. Okay, so we are about at an hour, which is what we said we were going to use for us to talk, and I hope that you have been submitting your questions. We'll have both Catherine and Diane reading us some of those questions. Our speakers were Robin Romano, Paul Woodruff, and Jim Benson. Jim Benson was first, then Robin, then Paul. So when you submit your questions, try to give us a heads up as to who you want to answer that question. All right, I'm going to turn it over to Catherine now.
Thank you, Vanessa. To the audience, I'm getting ready to push out our survey to you. So please, as we go over our Q&A, we'd appreciate it if you would do the survey. We do have quite a few questions, and we definitely appreciate all of those that have been submitted, and we still have time for some more submissions if you have some. We're going to give the first question to Vanessa. Vanessa, the credit union wants to know, this is question number 89. Can you briefly explain how a credit union would achieve a low-income designation?
Okay, so this was actually reviewed on some of the previous webinars that we've had about this. So if you go to the videos and webinar section of our website, you will find the prior low-income designation webinars, and I believe the first one has the most details about that. In summary, right now there's an automated process that is being done to test all credit unions to see if they meet the low-income designation requirement, and that's done through an ARIES file during the examination, and that's done annually. The Office of Consumer Protection manages those reviews and the process of notifying credit unions that they qualify or don't qualify. So if you want more information about that, you can get in touch with them.
Okay, thank you, Vanessa. The next question we're going to give to Paul. Are you ready, Paul?
I am.
All right. Question number 86. A credit union asks, if we wanted to start financial classes, where would we get material to know what to teach?
That's a really good question. We started with curriculum from the National Credit Union Foundation. I believe it was called Financial Education Classes in a Box. That was one quick outlet. I believe that some of the other materials that we have pulled from, and in all honesty, we've started to develop our own curriculum over the last couple of years from these, but from National Credit Union Foundation is a great resource. I believe that NCUA has provided us with some curriculum as well. And then the other source that I would go to is the Money Smart curriculum, which is offered through the FDIC. Those will give you a great starting point. And the last thing I would say with that is that if you are going to jump out to start to do some of these classes, use those materials as guidance points, but you really want to be able to tailor your message to the audience that you're searching. If you're just reading from those slides, nobody's going to be engaged. So really work to tailor that to the audience and get enthusiastic about it, and you'll have a lot of success.
Okay, Paul, while we have you on, I'm going to turn the console over to Diane Rector. She's going to give you question number 85.
Hi, Paul. You mentioned that borrowers have 10% withheld from advanced and placed into a savings account. But if you're holding funds, do you actually have the funds charged against the bottom line?
So I guess if I'm reading this correctly, so if we are taking 10% from whatever is advanced from the line, we do hold that. So whatever is in the secured savings account, we do hold that to mitigate some risk. So if somebody does walk away without payment, the member does not, per the agreement that we have, they don't have ownership to that. We do use that to cover some of the risk.
Okay, thank you, Paul. Let's see if we can get Robin to answer a question. Are you on the call, Robin?
I am.
Okay. A credit union wants to know, how did you market the second chance accounts and loans to get potential members, to come in and apply?
Well, when we first offered them, we had about 85% of our membership on direct deposit. We noticed that our members were going to payday lenders. So we had a product that we kind of marketed internally to our membership. But now we market it. I actually have a huge banner on the side of my building that says that markets the $500 loan. In addition, we do a show every other week on a local Spanish radio show going over various financial education, and we talk about this product as a way to develop. And like the other two credit unions, we do a lot of financial education out into the community. And this is a product we always talk about to them as well. So big banners on the outside of the building has worked very effectively. People see it and they walk in.
Just for clarification, is that a TV show or a radio show, and is there a cost to that?
The radio show that we do go to, there is a cost for that, and it's a local Spanish radio station. It's an AM station that we do.
Thank you.
Hi, this question is for Jim. Question number 91. What is your fee and rate on payday loans?
The fee and rate depend because we do risk-based lending. So the rate would be no more than say 18%, but we're kind of trying to lower that. So we actually lowered our unsecured loan rate so that actually the maximum is actually down to 14%. And so that would be if you have the worst credit. As far as fees, we kind of will waive those fees.
And while I have you on the line, do you charge application fees, and so how much?
We actually started charging that for first time, but because what we don't want to get into is these payday lending loans. I don't want to be associated with that. So basically we're kind of waiving that and taking that money and going to put it in the savings. We haven't, again, from listening today, we need to come up with a percentage like Rob and Paul have come up with. We need to incorporate that. So that money that they would give as a fee would possibly go into their savings and frozen there. So.
Nope.
Okay, thank you. Let's go to Paul. Mm-hmm. Are you there, Paul?
I am. Yep.
All righty. We have a question here from the credit union. It says, do you have tailored financial education programs, and how many staff are trained and deployed to provide this training?
It's a great question. So there's a couple answers to that. One is that inside of each of our branches, our branch managers, as well as some of our member service representative specialists, they are trained to do what's called a credit checkup. It's pretty simple. What we set up is that the members have the opportunity. They make an appointment with the branch manager or the MSR, and ahead of time, and they go in for the appointment, sit down. The branch manager or MSR will have a credit report with the score included. They'll go over that credit report with the member to explain to them, how to read the report, understand if there's any problems on it, how to fix some of those errors. They'll go over an amortization schedule to help members to understand, if you have an interest rate on a car loan that's 12% versus 8%, you're going to pay X number of dollars more. So that's kind of the basic training that we have for staff who deal with a lot of those issues day in and day out. But the second part is that the credit union and foundation jointly employ a full-time financial education specialist. We realize that that's somewhat of a luxury. I mean, we're a little bit bigger institution, so we can take on that expense. But Jason McCall, who is our specialist, he is the one that is out continually day in, day out teaching those services inside of social service agencies. And some of our branch members will step in who have been trained by him. But really, we have one specialist that focuses on it 100%, and the rest of our branch has basic understanding of how to counsel members.
Thank you. The next two questions is for Robin. Question number 28 for Robin.
Okay.
For the payday alternative loans, is anyone ever turned down? What would be the reason for denial? That's the first one.
That's a great question. Yes, people are turned down. This is a loan that is not really based upon credit. When you get into this type of loan, it's really based upon activity in either their savings or their checking account. We have found that to be the most useful way of determining payment because we don't pull credit history. So what we're looking for is what monies are flowing in and out, where those monies are going, and if other payday lenders are calling in or money's going elsewhere out to there. So a reason for the turn down would be usage of other payday lenders or being negative in their account a bit. We also offer overdraft privilege, and in general, we do not allow members to go use their overdraft privilege and do a quick loan, that's what we call this product, at the same time, because we view that as, robbing from Peter to pay Paul. So we do deny. It doesn't happen frequently, and we still charge them the application fee. So when they give us their application, it better come with $50. Hope that
Thanks, Robin. Question number 27 goes to you as well. Mm-hmm. Are the forced savings balances held until the loan is paid in full? They can't access the savings until the term of the loan expires? Is that
Absolutely. That's absolutely correct. So that money is held into a separate savings account, and it is held until the loan is paid in full. And we do not pay dividends on this particular account.
Okay. Thank you, Robin. Now I'm going to give this question out to all of our speakers. It's question number 105, and the credit union wants to know, this is a fantastic question, how do you combat car dealers that say 0% financing?
This is Jim Benson from the Elliott Credit Union. I think one of the things that we get that all the time is we just really have to point out the numbers. A lot of times the dealership says, hey, 0% financing, but now the $18,000 car is $20,000, and I will run the numbers for them and say, look, but if you take a 1.9% loan with us, we'll actually save you money, and that's kind of how we try to do it. Can't do it all the time because sometimes somebody with excellent credit will get the 0% financing and all the rebates. So we don't win them all, but we certainly can point out what we can. Thank you.
This is
okay.
Robin. I would say
Go ahead, Robin.
My answer would be exactly the same thing as pointing out that 0% really doesn't mean 0%. We've noticed in our market that the dealerships keep extending out these terms. Instead of 60 months being the most common term, we continue to see 72 months. So we do the same exact thing. But I will say this, I don't see many of those 0% financing because I don't have that many members that qualify for that.
This is Paul. I would say, yeah, I mean, we're in that category. Our members are severely financially distressed, so the opportunity to take advantage of that 0% financing is probably not going to be very ripe for many. But the last part is that it's just education. We let our members know what that real price is going to be and how they hide that. So same as everybody else.
Thank you very much for those answers. Question number 25 goes to Robin. Robin, do you have to have a certification to be able to host financial education instruction classes to your members?
No, you do not. In order to do counseling, such as HUD counseling, you do have to be certified for that. But to teach financial education classes on general things, for example, there was a great question about where do you get materials. I looked at some of the very same materials that Paul did, and we've kind of developed our own as well. And the things that we talk about are things that your loan officers talk to your members about every day. Credit, how to get it, what does the credit score mean, navigating how do I dispute credit, things like that. Those are things that you talk about on an everyday basis, and that we've turned that around and made those into presentations. We talk about basic banking and so forth. All of those things are things that you talk about every day. But there are specific things you do need to be certified, HUD counseling, foreclosure, that kind of stuff. There is a certification for that to say that you are HUD certified. I would offer, and I'm at the end, that if they give out information, our contact information, if somebody sends me an email and wants to see our credit class or PowerPoint, I'm happy to share it with anyone.
Okay, Robin, while we have you on the line again, here's another question. A credit union is interested in getting some details on your Start Again checking program.
I saw that question, and I'll be happy to, if they would email to me, I would be happy to send. We do have guidelines for that. We do not pull credit on Start Again checking. We only use check systems, and we do have specific guidelines. And you're catching me is that I can't remember what all of those are, but I would be happy to share that with the individual, Melanie, if she wants to send me an email.
Thanks. Number 64 goes to Vanessa. What are the requirements to become a low-income designated credit union?
Thank you, Diane. We kind of covered this before. Again, some of our prior webinars gave the details on that, but briefly, being low-income designated requires that more than 50% of your members are low-income as defined by NCUA. Let me start again because it looks like the mic wasn't on. I apologize. We covered that question a little bit before. Remember, there are at least two other low-income designation webinars that we've done in the past. So if you look on the NCUA website under our past videos, you'll find those. But briefly, the test looks to see if more than 50% of your membership meets the definition of low income. And that definition is somewhat complex because what we look at is census data and a lot of different census fields in order to determine if that person is living in an area that demonstrates that the predominance of people there are low income. So that's the brief answer, but again, the Office of Consumer Protection manages that more.
Vanessa, just a follow-up question. Can you tell us just briefly the benefits of being a low-income designated credit union, please?
Well, you'll notice I started out talking about the grants. And so those grants, the Community Development Revolving Loan Fund grants, are only for those credit unions that have both been offered, been told that they meet the criteria, and also accepted the low-income designation. In addition to the grants, we actually have a low-interest loan also that is available only to low-income designated credit unions. So those are the two main benefits that credit unions like to take advantage of.
Okay, we have a question that we'd like to give to all of our speakers. It involves being able to get underserved members off of traditional payday lenders. So the question is, what has worked for your institution and what hasn't? And then, if it's worked, how do you keep them away from the payday lenders? So I'm opening this question up to all of our speakers. Question 53, sorry.
I can jump out there. This is Paul. This is the real quandary because for a lot of folks, in order to get them completely out of the payday lending cycle, the real answer is to increase wages. It sounds really easy, right? But with our members, again, it goes back to education. The more that we can provide the resources that they need to understand how to manage the money that they do have, is a critical aspect to that. The second part is to be able to give them the capacity to save. So that's the big reason why we do have a forced savings component with our payday loan alternative. We've had members that have really been able to leverage that once they've saved a couple $100s. And these are folks that really have never had the chance to save hundreds of dollars at a time. I would like to say that we've had a huge success in getting people out of payday lenders. The real answer to that is that it's mixed. So we continue to try to refine that, and the success stories that we do have, I think, come from the education piece and then also the savings component that we're helping our members with.
This is Robin. We've had a mix of people who use payday lenders. I don't want people to assume that only the poorest, most underserved areas use payday lenders. While they certainly prey on these people, everyone uses payday lenders. So we had people who have A-plus credit that we see payday lenders come through on. The quick loan has been very successful in about 25 to 30% of the people who use quick loans to help either reestablish credit or obtain credit do graduate to other forms of unsecured credit beyond the quick loans. The forced savings on the quick loan product has probably been very successful in that, to showing that someone that, hey, I can save a little money so I don't have to reach out and make bad choices to be able to fix that washer or to do, to get money to do something from alternative sources. We also use forced savings sometimes in regular loans. If we have a member that is coming to us every 8 to 9 months to either do debt consolidation or because they need money now to buy tires for their truck or whatever, we may set them up on a payment and put them also on a forced savings, saying that a part of your, we're going to put into your payment that you have to put savings to money. So that savings aspect is very powerful in trying to help that. But the biggest power is really talking and having your loan officers talk to these people so that they can see what it's costing them in the decisions and how much more money they're paying out on that. And then the other thing is, what we have found is that they want to have to stop. There are some people who will never stop, and you need to recognize at some point at what time that you need to exit out of their lives because they're not going to stop that behavior.
This is Jim Benson. I'll step in real quick, but since we are kind of new to this, but what we have seen is try to work with get people off of payday lenders is, like Robin and Paul have said, we try to get them also on a payroll deduction if we can get them. And also I've seen people that are making good money that are going to payday lenders. I don't know why. What we try to do is to try to get them on a payroll deduction so that we can get them a loan, so that we build that relationship. And as Robin has said, there's some people that will just always do it, and yes, we cut our ties because there's nothing you can do. And that's not in all cases, but in some cases we really have succeeded in helping people. And I know today I run into people at Walmart at different stores, and they say, hey, Jim, yeah, you remember how things were? And I'm like, yes, I know. And it's a good feeling to see that, yeah, we pulled them out of there, and we're able to get them to get back on track. And those are the people that, okay, you got them on the payroll deduction, got them off of that vicious cycle. And I mean, it's like I said, it's a case by case. You try to work with somebody and say, look, let's work on a budget. And a lot of times that helps when we show them, hey, look, you've got to stop. So thank you.
Okay. So the next question number 66, we're going to give that to Vanessa. Vanessa, the credit union wants to know, can they use the NCUA grant to improve on some of the current products and services that they offer?
Thank you, Catherine. I saw that question, and it's interesting. We have been getting a lot of demand for our grants, as you can probably understand, particularly since so many more credit unions receive the low-income designation. So we are purposely really offering these funds for those groups that do not yet have these products and services. So it truly is first-time offerings. The continuation of that says that the person might want to improve on their mobile banking or improve on bill pay systems. So we congratulate you for getting those started, and we really hope that you have it available in your operating funds to really keep those programs going and improve on them. But we are trying to dedicate our funds to those who don't already have those programs and services.
Thanks, Vanessa. This question goes to Robin. Question number 30. Does the self-funding private mortgage insurance account pays dividends?
That's a terrific question, and I have to tell you, we really debated on this one or not. We do not pay dividends on this particular account. Because it was insurance, we felt at its core that we weren't going to pay dividends. But that's a debate we had long and hard on this particular. I think you can do no wrong whether you pay dividends or not, but we do not.
Okay, let's bounce the ball back to Vanessa. Question number 70. I'm sorry. Actually, let's stay with Vanessa anyway. Question number 14. Credit union wants to know, what is a SEG?
Oh, that's just the acronym for Select Employee Group, the old-fashioned credit union term, meaning, an employer base that you get in to sign up, and then you get access to their employees as your membership.
Okay, fantastic. While I have you, Vanessa, can I ask you question number 10 too? Apparently, the credit union wants to know some information about the CDFI index, and what is it, and what role does it play in qualifying for CDFI certification?
Okay, that's a good question, and you'll find more guidance in the guidance material for the application. But essentially, I can summarize that in order to be certified by the CDFI Fund, you actually need to show that 60% of your prior year's products and services have been provided to the low-income community. Now, there are different definitions of low-income community. It could be, demographics, it's been shown by studies that African Americans, Hispanics, Latinos often lack access to credit for reasons other than credit. So some of those are sort of like, okay, that's a definition of underserved community. Low income, meaning you're serving people and have the data to show that you're serving people who are below a certain area median income, things like that. So that's the main criteria, is demonstrating that the predominance, and actually 60%, not just more than 50%, have gone to an underserved community. The other criteria that sometimes, and I will say that sometimes credit unions have trouble meeting, even though they might be serving a large predominance of low-income members, is that you need to have documentation that demonstrates that your mission shows that you are dedicated to serving the underserved. And so what some institutions have to do is they might have to pass another sort of bylaw statement that incorporates that in their mission, because, most financial institutions, their mission is to provide financial services. And so maybe changing that to provide financial services to the underserved market, something like that is needed to demonstrate. Then the other criteria is like proving that you're a financial institution. That's a pretty easy swing for credit unions because you are regulated by NCUA. But the target market criteria demonstrating that you've provided those 60% of services, that can be one of the tough hurdles to get over because it requires quite a bit of analysis and data, and that's why we're offering the funds to help you hire a consultant to look at that. So I hope that answers the question.
Okay, thank you, Vanessa. I have a final question for our entire group here. The question is, do you run a credit report for your ATM card?
This is Jim Benson. Our ATM is actually linked to the Visa the Visa debit card, and it's linked to the share draft, so we do run the check system report. And that's where we'll start from. So that's all.
This is Paul. We stopped offering just the standard ATM card. Everybody has a regular debit card that can access the ATM. But in answer to that, we don't use credit as a basis for qualification for the checking account, and thus the debit card, ATM card. And and the other thing is with our accounts, we can also overlook some blemishes on check systems. So we've been pretty liberal in that policy. And if people can't qualify, then we have some pay card options that are cheaper than some of the more expensive cards that exist out there.
This is Robin. We do not run a credit report for the ATM or for the checking accounts. We did do check systems for the ATM card. We have found that check systems is a much better indicator of how somebody will run their account versus the credit report. We have found, in specific in serving these particular markets, that people treat their accounts much differently than they treat loans because they need those accounts desperately. So we don't run credit, but we do run check systems.
All righty. Well, thank you, everyone, for joining us for this particular webinar. Join us next week on the 22nd when we will have another exciting webinar on examination modernization. If we didn't answer your questions today, we certainly will answer them within the next few weeks. And this webinar will be posted to our website in approximately 3 weeks for on-demand viewing. Once again, thank you, audience, for tuning in. Thank you, Vanessa. Thank you, speakers. And we'll see you all next week at 2 p.m. for examination modernization. Have a great afternoon.